A lot of problems in the world. Andy mentioned a bunch of them earlier, but the markets are hitting new highs, not just here, but elsewhere. And you've seen pretty strong moves from economies that you haven't seen strong market moves in. So a lot to cover today. I think the world's not going to play out exactly how people had hoped at the start of the year. But I want to touch on the global economy, challenges to growth in the markets. And I have a lot of slides, so I'm going to go through them fairly quickly. But the OECD just came out with their updated projections for growth, and looking at about 3% this year, 3% next year. I think the big issue from November, the big change is Germany. They lowered the expectations, even though they're up from where they were. They're still in the negative trend for 24, as is Argentina and Saudi Arabia. The U.S. and Russia, ironically, are the two that are on the upswing. I think Russia's economy is being supported by a war effort that's not the foundation you would look to have for the longer term. But there's clearly a lot going on and a lot of mixed messages from the markets. I'm surprised China wasn't downgraded on their numbers, but we'll see where that goes. We'll touch on each of these in a minute. But the big issue is that inflation is moving closer to target. I think the markets got ahead of themselves in the U.S. and elsewhere, thinking that central banks are going to ease much faster. We'll touch on why they're not in a few minutes. I think there's some challenges to the system that are going to slow them down, but the trend for inflation is positive. The negative in that is, while the inflation number looks good, what populations are dealing with is cost of living, which is much higher. And that's the disconnect from administrations and the populace. When they're talking about inflation coming down and the people are reacting very negatively to it, it's because their cost of living is going up. And it just was a reminder that inflation is a point-in-point time, but cost of living is what you live, that's the basket you live off of. So I think that's the challenge. I think as we look at the US, doing much better than anticipated, inflation is in line, but as you saw with the numbers today, the battle's not done. And I think Powell's hesitancy was the right approach. We've been saying that the market was way ahead of themselves since the November and December meetings. We think that's still the case, but growth is really strong too. And I think that's what people are missing, is the strength of the economy with full employment makes it very difficult to get too far ahead of cutting rates when you can trigger some inflationary pressures coming. So we have some more challenges there. I think Europe is struggling for growth, but inflation is improving. I think you're seeing some really interesting pockets of opportunity. And I learned a new acronym today for the U.S. It's the Magnificent Seven. For Europe, they're calling it granola, which is a couple big companies that are doing quite well there. It's Glaxo, Roche, ASML, Nestle, Novartis, and Novo Nordisk, L'Oreal, LVMH, AstraZeneca, SAP, and Sanofi. Those companies are selling for a pretty significant discount to the Magnificent Seven. I think they're running at about 20 multiples of PE versus 30 for the Magnificent Seven. I think their dividend yield is about 2.5%. And when you look at their these stocks account for 60% of the gains that Europe's had over the past year. So I've been very negative on Europe. I have touched on pockets of opportunity. And what you're looking at here is really tech, a couple consumer companies, and healthcare are what really are driving what's going on over there. And I think there's some opportunities to make money in all the different markets. You just have to be really careful about what you're picking. I think Europe has some real structural problems, though, that will take quite some time to get through. And if you want to look up the German finance minister's recent comments, they are not very positive about their version of the outlook for what's going on. I think they called it a unfit man in need of structural reforms to get back on track. And I think they're right. So it's going to be interesting to see how that plays out. But even when you're looking at negative areas, there are pockets of opportunity. And those 7 stocks are just in the public markets, a sense of where you can find opportunity in Europe now. Japan is still seeing low growth, but inflation has actually picked up and getting nearer to their target. Their market has done quite well over the last year and a little bit more year to date. Buffett's timing was quite good there, but I think they have some structural issues that they have to work through as well. Their industry is struggling. I think their population growth is non-existent. They're starting to bring in immigrants, but how they bring them into the system needs to be really thought through. I think the big story still remains China, and it was last year, and I think it will be this year. And where does it go from here? And I think it's not just an economic story, but the social and political story is real. I think the headwinds that China's facing are real painful and somewhat self-inflicted. I think what you have to keep in mind, though, is for all their problems, they have so much to offer as an economy for businesses that the real dilemma is how do you get back on track, or how do you invest there with confidence? And I think that's the biggest self-inflicted wound that China put on, is the discouragement of foreign direct investment, and that kind of a trend. What's it going to take to reverse that? I think is a big question for businesses going forward, and I think that'll really be a big determinant of what are global relations like, and are we going to move to a bifurcated system between autocratic and democratic nations, or do we play it a little more straightforward and move to more normal economic relations? I don't know the answer to that, but I think China has the key to that. I want to switch gears to the challenges that are out there and in the global system today. I think energy prices, these are the near-term issues, and well, energy prices have been one of the startling things. And when you go back to 2008, when you think about the difference between then and now, and why the need to bring rates down so much when we had a debt crisis then and we have a debt problem now, I think the difference in what's really confounding the inflation story is that we don't have energy prices high. We have them low and not really moving up very much. They've come down quite a bit. And I think that's helped consumers a lot in the US. I think it's helped somewhat in Europe, but I think it's also now putting greater strains on the governments, and we'll talk about that. I think the choke points for trade from the disruptions around the Strait of Hormuz and the Suez Canal and the Panama Canal are issues, but they haven't created the problems in terms of inflation yet, because I think the market views them not to be long-term issues. Or it could be that we've just learned to adjust to supply chain disruptions from what we've experienced the last couple of years. But I think as we switch to the longer term issues, the changing terms of trade is a big one. And this started with Trump and the Trump administration. It'll get worse if he follows through on his commitments, if he's reelected, of 60% tariffs on imports from China, 10% tariffs on imports from around the world. That is really changing the way people think about global trade. When you add to that some of the other issues, this is one that could slow down growth for some time. Also, if we move to a bifurcated system, as we were just touching on, then you're going to be really creating all these redundancies, which makes it a far less efficient system overall. So we have to see how that plays out. I think climate is another big area that we have to get our arms around. And not that people don't understand the problem, it's how do we get to the right answer for the problem. And you can see water temperatures rising. That's going to create big problems for the healthcare industry. That's flowing through in one of the big areas of inflation, certainly in the US, is higher insurance costs. And that's playing out in all aspects of it. It's going to really weigh on property, and it's going to weigh on cities and states very heavily because of the damage and the issues that are coming for that. How do you insure homes, and what's it going to do to property values and other real estate values? I think we have the other issue on the CO2 emissions, that we have to get to a better spot there, but it's going to take longer than we think. And that's really the dilemma that we've talked about for some time. It's also going to cost a lot more to do than originally planned. How do governments adjust to that is going to be one of the big elements. I think the other challenge too is that we have debt at such high levels and around the world, and we now have over 307 trillion of debt. I understand that Europe's economy for the last 6 quarters is growing at a rate that's negative compared to the rate of its debt. And that is not a great long-term situation or short-term situation, but I think it's been 6 quarters that growth has lagged the increase in debts. And when you have that kind of a scenario, that leads to serious crowding out. And I think that one of the challenges for government expenditures is we have a lot of needs, and yet governments are going to have to pull back some of the support that they've given because we can't keep providing the level of expenditures we've been for the last several years. I believe one of the areas that's going to get hurt most by this will be the educational system, which probably needs it the most. So we're mortgaging our future to spend for things today that may not get the same return as investing in our youth. So this is a challenge for governments. I think you're seeing this play out with the protests in Europe and other places, and now we're having farmers protest here as well. When you start to see the government support and subsidies start to go away, that actually increases the inflationary pressures on consumers, and that puts governments in a bind, leads to more protests, and often leads to new governments making the decisions, usually stuck with the same problems and don't provide better solutions, but at least you have a change in government. I think that's really the net. I think one of the big challenges here is capital allocation for governments, and I think they're going to run into some real problems given their finances. So switching gears to the markets, because as the world economy is changing, the markets are as well. And this was an interesting chart that came out from the Asia Nikkei, and they're looking at, in the dark blue is the US, the light blue is Europe, gray is Japan, yellow is India, and the red is China. And China was moving towards 20% of global market capitalization and is now trending down towards 10%. And when I said some of the problems that China has are self-inflicted, I think the damage to confidence of foreign investors coming into China right now is quite high. I think there are pockets of opportunity. You have to decide how you want to invest there and play. But I think CEOs are really struggling right now to think, how do I play the China market? How do I get involved in it? China's giving you a roadmap. It's really interesting if you can follow that or not. And everyone wants to get the Chinese consumer, but is it going to be worth the effort? I think is a question companies are going to be asking themselves. So for us, we still favor the US over other areas. But as I said, really interesting pockets of opportunity everywhere. And we don't think you want to own the markets. You want to own businesses anyway. And I think the themes that we apply be the same themes in the public market and the private markets. And I really think the difference is going to be how much liquidity you're willing to take or give up for the return expectations that you have, and the potential longer holding periods, given that rates are not coming down as much as everyone hoped this year, and we're dealing with 4% or 5% interest rates as opposed to zero. And what does that mean for your return profiles and expectations? I thought there's an interesting chart that showed what the top 10 most valuable companies in December of 2020 are and what they are today. And what's interesting is you saw Tencent and Alibaba drop off this list. You saw some more US companies come in, and the only foreign company right now in the top 10 most valuable publicly traded companies is Aramco. So I think this speaks to the strength of the US. It speaks to the innovation that's going on here. It also speaks to how concentrated the risks are and the bets are in the global system and the power of big tech. I think that's starting to be diversified out into other areas, but clearly, Mark, the AI story that's coming up, these are the dominant players in that and the big beneficiaries of that in many cases. So I think you have more to see, but it would be healthy for the global economy if you had more of the top 10 more diversified. But I don't see that under the current circumstances being quite as easy to get back on track. So where do we put money today and how do we think about it? I think the big themes, and one that is really underlooked is, I think Europe's looking at this very heavily, is the Inflation Reduction Act, the policies that the US put in place, the policies that China has in place to determine where they want capital to flow and drive their economy forward are very highly defined. I think that is the Achilles heel of Europe and other nations, other areas. And I think you have to determine, does your industrial policy match up to what your goals are for your population? Are you doing the right steps to match what you're good at and what you need to be good at to be successful? I think the cost of living issue is really creating a lot of social strains, and that's going to lead to a lot of political strains as well, but it is really hurting the consumer. As much as the consumer's done a good job of getting their cash flows to debt aligned and improved, I think the debt burdens are high, and you'll see that push through, and it's going to lead to increased frustration. There are also more wage increases coming through in Europe and in the US that are another reason why the central banks are a little slow to move. The auto workers in Germany are up for their renewal. They're looking for 21% increases. A lot of other workers, because of the increases from some of the unions, are looking to see 4 and 5% increases coming through. And in the US, Boeing is up for negotiation with some of their unions this year. And Boeing, all throughout their system, employs, I think, well over 1.3 million people between them and their network of companies. So you can see cost increases can creep through the system, and that leads to some bigger challenges. And you're seeing that in the retail area. These cost of living increases are bleeding into McDonald's pricing, for example, where a Big Mac meal in Connecticut can run over $19, and they're citing 3 costs that are leading to that. Input costs for their food is one, but then you have minimum wage increases coming through their system. And then you add to that the third area, which I'm now blanking on, I'm sorry. There's a third, insurance costs are also coming through to the franchisees, and that's creating big increases. And when you're seeing insurance costs increasing anywhere from 10 to 20% on your bottom line, how do you make that up? You're going to push through higher prices, and will you still get the receptivity? So price elasticity is going to be a big issue for the haves and have-nots. I think we're going to continue to see the world divide, and I don't see that getting any better anytime soon. What's going on in the Middle East is one example. What's going on in Europe, again, are we going to hold together and support the Ukraine or not? And the debacle in Washington, D.C. right now and putting through what is absolutely essential aid to Europe and the Middle East, and to stop the border problem, getting caught up in the politics of the next election is pretty disgusting. Not what the people were put in office to do. I think the big theme for us that really is playing out, and a big opportunity, is the reindustrialization of the global economy, the US being a major beneficiary of that. I think Europe and China are getting hurt by that. You're seeing Mexico a big beneficiary. Countries like Poland and other areas in the Southeast Asia are all benefiting from this. But you have to have the right mindset of the government leaders to be not only positioned for it, but recognizing the opportunity and seizing it with the right policies. And you need a balance sheet that allows you to do that. A lot of countries are not have the financial wherewithal to move forward. I think the areas we're focused on are the same ones we've been focused on for some time, Mark. So I'm going to stop there and open up for discussion so we can get to 10 minutes, and we can get to the AI group, because I'm particularly interested to hear where they're going.
Excellent. Thank you again, Stephen. Adam, your hand's up fast.
Thank you, Mark. Stephen, thank you for the presentation. I've got 2 questions. The first one, given the strength of the economy, low unemployment, why is the American public not happy with the economy? What's the problem here? That's my first question. Second question, which is much easier. You said that the Chinese capitalization, global capitalization, was somewhere around 20% and now trending to 10%. What is the US capitalization? And from 20% to 10%, that's a very steep drop.
Yep. Yeah. I'll start with the second one first. The US is around 48%, 47.5, I believe, is the actual number. That moved up a little bit. I think other countries are picking up in Southeast Asia, are picking up some of China's market capitalization. Japan's coming back, 11% move in Japan actually or 13%, I forget where it is somewhat meaningful as well. But I think it's the Chinese policies that discouraged foreign investment, and what they did to, when they take out Jack Ma and Alibaba and take them to the woodshed and do some other things. So if their national champions aren't safe, how are foreign national champions going to be safe there? I think that's really what's going on. And I think the other element is, as the consumers had so much of their net worth in real estate, as real estate goes, they trade the stock market more. So their confidence is falling through, and confidence is a big thing that drives markets. So I think those are the combinations. I think the disconnect between the populations and the inflation number is that inflation isn't what you eat. It's just a point in time number, and people are struggling with the higher costs. And if you think about it, if it's $18 for one Big Mac meal, right, and you take a family of 4 out, you're better off going to a regular restaurant, not getting fast food, and probably getting a better, potentially better meal. People could argue with their likes or dislikes of McDonald's, but I think that's a real issue when you think about them moving to that level of paying $18 for fries and a burger. You can go to a restaurant and get that. And I think that's one of the challenges that you're going to see. And that frustration comes through. You're seeing that again, inflation's down, but the prices that you pay for an automobile are not coming down. They're just not going up as much. So it's the things that you need to buy are still more expensive than they were before. The inflation number looks good, but that's not what you eat off of. And I think that's where the Biden administration's messaging is being lost on people when they've done a good job with the economy. It looks good, but it doesn't feel great to people.
But are the wages not increasing beyond inflation? I mean, at least keeping up? And
I think the problem is it's been so long that people have, in many areas, have seen wage increases coming through that they're behind already. And getting ahead is the hard part. But everyone's different too. And this gets into the big gaps between the haves and have-nots. Your confidence is a lot higher if you have equities.
Thank you, Stephen.
Michael?
So one of the areas you mentioned that you're favoring is energy, fossil fuels. It's really interesting what's going on with natural gas. People know I follow that closely. And, front month, March, is down to $1.68 today. And oil has been holding up fairly well. And when I look at the activity here in the Utica, lots of activity. The hotel parking lots are full of the vehicles of the Halliburton and other service folks. The sandboxes with fracking sands are all over the roads. So I'm actually thinking now that we may see a situation in the spot market coming up where in the past where we saw negative $35 paying people to take natural gas because the storage tanks are full. And so this is just really interesting because I would have expected by now for activity to slow down, and it's not.
Michael, how are we positioned for export? That was a discussion when the Russians cut off the gas or vice versa to Germany. Our terminaling capacity for LNG, at least, because that can pick up some of that slack.
So exports are fairly good. The one export terminal that had the fire is pretty much back online. The pause by the Biden administration really isn't impacting current projects that are underway. It's really about future projects. And I think with everything that I see, and I'm not a evangelist for the natural gas industry, but I think it's a mistake to hold up those permits. The markets will sort out what happens. Better to have capacity, just like with office space, commercial office space right now. The market's going to revalue all of those buildings. They're not going to just disappear. And so if people want to make bets on export terminals, I think that they should be allowed to.
Fair enough. All right. It's definitely a long-term asset. Sam? Hasty?
Yeah, thanks, Mark. Stephen, I'm actually just curious. I think I'm hearing hints about the consumer, but is this sort of like a train heading towards a cliff? Like, how are you thinking about the consumer right now, practically speaking?
I think you have to think about multiple consumers. When you look at the aggregate, the numbers look okay. When you go beneath the covers, the amount of boomers retiring and their net worth versus the rest of the world is very different. So I think you have to think about them in very different ways. I think one of the surprises is the number of boomers that are retiring every year that have 75 trillion of, that segment, the boomer segment has $75 trillion of net worth that they're going to keep spending, and that's prop things up. The other end is very different, and I think the haves and have-nots is really what is driving it. I think you're going to see, it's very discouraging to be a 25-year-old or a 30-year-old today and think about buying a home or getting married and starting a family. And how do you do that? And how do you move forward with cars and all that? But there is a big mix of the haves and have-nots, and I think that that aggregate numbers are masking some of the challenges underneath. I will say overall, though, the debt levels, that cash flow to debt is a big issue, and that it has been, I think people got religion after the great financial crisis about not having too much debt. It's starting to creep up now, though, and I think you're going to have to keep an eye on that. And can their earnings grow faster than the rate of debt?
Steve, we got two more questions here. John and Dieter. John, you want to lead off?
Thank you. I'm really puzzled by Japan. Okay. I mean, we keep talking about an eventual reckoning on the debt load, but in the case of Japan's retirees to worker ratio is probably the highest in the world, and their debt to GDP is well over 2. But I read nothing about some kind of a reckoning. Can you tell me why that's the case?
Well, they're a big saving system, so that helps deal with it because they're very closed. So I think their debt is mainly internal as opposed to external. So you can manage your debt problems better that way. But I think they've done what people do when they can't grow, is you defease the debt by increasing your debt levels and hoping that your asset values grow. They were slow to see the assets grow, but now they're starting to pick up. I think they're a very different economy than the U.S. or most other economies. And I think that throws us off. If we think about it the way we think about the U.S., it doesn't work the same way. What drives their economy is very different than ours. We are a very consumer-driven economy, but we rely on the multitude of businesses that industries that we're leading in. I think they're in the process of trying to find new industries to lead. And I think that's been one of their challenges. So I think they've just defeased the debt is really what they're doing by printing money and hoping.
One more question, Stephen. Sorry. Dieter.
Hi, Stephen. I would like to get your opinion about the chart where you showed the 10 most valuable companies, and 9 of them have been Americans. I don't think it's not only the valuation, but the dry powder and the cash they have available to invest in new technology and acquiring competitors. When I look at the top German companies or European companies, more or less nobody has real cash. And they don't create a lot of cash flow. That's why the valuation. I think the same is for other companies in Japan and other areas of the world. I would like to get your opinion. How influential will this to be that this 9 companies even are getting bigger and bigger and bigger in the future and make us in US more heavy involved in the world's new technology?
Yeah, I think their cash flows have allowed them to do things that other people can't, and that has made them uniquely positioned to grow. But it's actually interesting. One of the big changes that's improved their valuation in the last year is how much they've cut back their spending, which made them much more efficient, because that was one of the concerns, was that they were going to keep spending without any regard for the consumer or for their investors. And now that the year of efficiency that Meta put through last year and the layoffs and all that have given them a religion that they have the finances to invest in growth. They've been investing in growth. They've made a lot of acquisitions. So I think they are in a different spot than everyone else is. And I think you're right. I think the companies that are going to win in this environment will be innovators with big cash flows that can continue to invest in and make acquisitions or cut their cost effectively.